sir. Good afternoon. We welcome you to today's session on gearing up for the income tax return filings for the assessment year 25-26. And for the participants, we have CMA CA Ajit Shivadas with us for today's session. We welcome you to the session, sir, and over to you for this to take up the discussion. Thank you so much.
Thanks a lot, madam. Thank you, TRD, giving me this opportunity to interact with the members regarding the hot topic, gearing up to filing of income tax returns for the assessment year 25-26. Hope I am audible and my PPT is also visible to you.
Sir, you're audible and visible both. Thank you.
Thank you. So now we are again at another tax filing season, I would call. We are welcoming this assessment year 25-26. And for this year, the relevance is with regarding to that introduction of new finance or income tax bill, which is going to get applicable from 1st day of April 2026. So next year, definitely, yes, we are going to get adopted with all those new income tax bill provisions, which are going to get applicable from tax year 26-27 assessment year, even though there is no terminology assessment year, 27-28 returns only. Those new tax bill provisions would be make applicable. So for this assessment year 25-26 as well as for assessment year 26-27, the existing Income Tax Act 1961 and all the procedures, all the forms, everything would be intact only. From the year of filing for with regarding to previous year or a tax year 26-27, from 27-28 year after tax year, if you are filing the return, then only the new bill provisions, new act provisions would be coming into force. So with this prelude, let us move on to discuss those returns regarding legal provisions, ITR forms, recent amendment, certain do's and don'ts with regarding to filing of income tax returns. So today, actually, we are not going to have a discussion over those tax audit returns, only those returns which are supposed to file within 31st of July. Non-tax audit cases only we would be having a discussion over. And we know the fundamental section 139 of present act deals with those persons who are required to file the returns in income tax proposed bill 2025. The corresponding clause is 263. All those provisions which are existing in 139, you can see in 263 also. So here under 139, under present provisions, the company and firm, irrespective of whether they are having losses or income, whether they are in operation or not, irrespective of all those things, company and firm is required to file income tax return compulsorily. Apart from company and firm, may it be an individual AOP, BOI, or maybe a local authority, then they would be required to file the income tax returns only if their income before exemptions, before deductions is more than basic exemption limit on the basis of various slab rates. And apart from that, there are various institutions, medical institutions, education institutions, there are various research associations, trusts, etc., political parties, etc., who are having income tax exemption. They are also required to file the return compulsorily. So these are all the persons who would be required to file the returns. Even though your income is less than basic exemption limit, in the previous slide I was mentioning, if any persons other than the company and firm, they are required to file the return. Say an individual is required to file the return only if their total income is more than basic exemption limit I was mentioning. So even though your income is not more than basic exemption limit, say your income is only 2 lakh rupees or 1,50,000 rupees, or if you are incurring a loss, if you are not having any income. But if you indulge to any of those transactions which appears in the current slide, if you are having any of those transactions as below mentioned, then irrespective of whether or not you are having income more than the basic exemption limit or not, you would be mandatorily required to file the return. So what are all those conditions? What are all those events which would make you to file the return mandatorily? First one, if you are holding or as a beneficial on or as otherwise any asset located outside India. So if you are having any asset located outside India, irrespective of whether you are having taxable income here or not, you are required to file the return. If you are a beneficiary of any asset located outside India, then also you would be required to do it. Then if you have deposited amount more than 1 crore in one or more current accounts, not on saving accounts, for current accounts, suppose you have filed or deposited more than 1 crore rupees, then again you would be required to file the return. Then if you have spent more than 2 lakh rupees on foreign travel, then again you would be required to file the return irrespective of your income. If you have incurred electricity consumption, electricity expenditure more than 1 lakh rupees in a year, you would be again required to file the return. Then if you are having sales, turnover, gross receipts from your business over and above 60 lakh rupees, then again mandatory return. If your professional turnover is more than 10 lakh rupees, mandatory required to do it. Then if your TDS collected during the previous year is 5,000 in case of a person and 50,000 in case of senior citizen, then also you would be required to file the returns. Then current account 1 crore rupees we were mentioning. In savings bank account, if you are depositing more than 50 lakh rupees, you would be required to file the return. And if you are holding a credit card, so all credit card holders, any credit card or add-on card holders issued by any bank or institution, irrespective of their income, they would be required to file their income tax returns. Then in any member or a club where the entrance fees is more than 25,000 rupees, then in such members of such club also would be required to file the return irrespective of their income. So these are all those persons who are required to file the return. For a nutshell, sort of an explanation, all these 4 persons, as I was mentioning earlier, company, firm, any other person having income more than basic exemption limit before exemptions and deductions, and specified entities in form of trust, political parties, medical institution, education institution I was mentioning. And even though your income is less than basic exemption limit for third categories, if you indulge in any of those transactions which has been mentioned in this slide, also would be required to file the return mandatorily. Then, today's discussion, we would be discussing about the statute, the fundamental section 139, what are all the various types of returns we would be. Then just a brush upon various forms ranging from ITR 1 to ITR 7. Then recent changes, which are all those changes which are applicable by Finance Act 2024. In the year 2024, we had 2 budgets because it was a central election year. So one budget in February 1st and 23rd July, we had another budget. So those budget amendments, which is applicable for financial year 24-25, applicable for 25-26, we would be touching upon all those practical things are there in that budget. So those things we would be touching upon. Then various special points I was mentioning, various forms, various do's, various don'ts, various special things which are appearing in income tax returns also we would be discussing. When and there required, definitely yes, learned audience can raise your queries in that question and answer box. At the end of session, we would be discussing all those questions. So with this prelude, on to the contents. Types of returns, we know section 139 deals with the returns to be submitted by an assessee. 139.1 talks about original return. Original return meaning those returns which has to be filed by those persons as we were mentioning earlier within the due date which is being specified. So the due date, we know first due date is July 31st. Those individuals or assessees other than company who doesn't have got a tax audit. So in case of non-tax audit, normal individual, HUF, firm, AVOP, BOI, other than company, assessees, if you are not having tax audit, then your due date to file the return as per the time limit under 139.1 is 31st of July. And we know for those assessees who are having tax audit, the tax audit report have to be submitted on or before 30th of September. But the income tax return due date is 1 month after, which comes on 31st of October. Then for those persons who are required to submit 92E report, international transaction if you are indulging with, then you are supposed to file the return on or before 30th of November. So these are all those cutoff dates wherein you can file the return under 139.1. And you would be required to file this income tax returns within this time limit, not under belated limit up to December or not under updated return up to 48 months delay, you cannot carry forward the loss under PGBP, under capital gain. There are restrictions for getting refunds also in the new income tax bill. You may see even belated return, you would not be eligible to get refund. Now that case is on updated return alone. Now in case up to December, you can have those returns with refund claims. And the new income tax bill proposes for refund returns within the time limit as specified under 139(1) itself. So those things are there under this normal return, timely return under section 139(1). Then comes belated return. Belated return talks about those returns who have missed to file within so-called time limits as specified under 139 after 31st July, after 31st of October, after 30th of November, up to 31st of December of the current assessment year. You can file the return, but it would be termed to be as belated return. On belated return, the consequences, certain losses, certain losses you cannot carry forward, we were mentioning. Apart from which 234F late fee would be there. Interest also would be there on tax payable under section 234A, 1% per month or part thereof. So this is the second type of return, belated return. If you have submitted the return and you are having any corrections to be done, those corrections can be done within 31st of December, and such corrections are under this revised return 139(5). Then, even though you missed all these time limits, you couldn't file it within 31st of July, you couldn't file within 31st of December. Now, after Finance Bill 2025, the time limit for updated return have been extended. Now, the time limit for updated return is up to 24 months from the end of assessment year. But right from this assessment year 25-26, you can go back to 4 years. 4 years in the sense, say the current assessment year 25-26, you can file 25-26, you can file 24-25 as per updated return, 23-24, 22-23, as well as 21-22. So right from assessment year 21-22 till assessment year 24-25, even though the time limits under 139(1) and 139(4) is over, by virtue of amendment in Finance Bill 2025, you can still continue to file the return. 48 months have been extended from the end of relevant assessment year, whether or not a return was originally filed. Subject to the condition that we know up to 12 months delay, you have to go for up to 12 months delay, you have to pay additional tax under 140B, 25%. So over and above the normal taxes, normal cess, normal interest, all those taxes plus cesses plus interest over and above, on that amount you would be required to pay 25% extra under 140B in order to file that updated return. And if the delay is up to 24 months, 50% of tax you would be required to pay extra instead of 25. For 36 months, 60% you would be required to pay. For 48 months delay, you would be required to pay 70% under 140B. But there are various conditions for filing updated return. Updated return should not be for a refund claim. It should not be a loss return. It should not be again updated. It cannot be again updated. It cannot be used by assessees who have been under search seizure cases. So various restrictions are also there for those who are going to file these updated returns. So these are all various technical returns that you can file. And even though you missed all these time limits, then again, there is a condonation option available before the commissioner under section 119(2)(b), wherein due to genuine hardship, you couldn't file the return. Using the condonation, this thing, you can still file the return. Then if you missed to file the returns and there were certain transactions in form of what do you call RMS, risk management, system related transactions, AAS sort of things, high value transactions you have indulged during the period, then the department would be issuing you with 148A income escapement related notices. After getting those notices, you can still file the return under section 148. So that type of returns is also there, which would be treated to be in par with 139 returns. Then if you have filed the return and some basic errors were there, maybe some technical issues, maybe some technical differences in figures, heads of income calculations, etc., then it can be caught for defective for various forms you are supposed to upload along with the returns, which was found to be missing. On all those cases, your return can be caught up to be as a defective return, and it would be selected for section 139(9) categories, and you have to rectify such mistakes, and you are supposed to file the rectified defect return within 15 days, which is extendable, but within 15 days you have to correct the same, without which the original return submitted by you would become null and void, invalidated. If you are submitting the new return within 15 days, then the return submitted would be getting reinstated. This is what about defective return. Then talking about 148, already I have mentioned. If you fail to file the return, you have not utilized any opportunity, the department would be issuing you notices to show cause why not. Income escapement assessment can be initiated. If you cannot give a satisfactory reply, then the department would be issuing you with a notice under section 148, which would be another opportunity for you to file the return. If you avail the opportunity, that return would be far equal to section 139 returns. After those statutes with relating to the return submission, now we are having 7 forms. There was a proposal earlier. Apart from this ITR 7, all the other ITRs from ITR 1 to ITR 6, a common return would be getting implemented. 2 years before, there was such a propaganda. But till now, there is no such implementation regarding various forms ranging from ITR 1 to ITR 6. So still now, the old ITR 1 to ITR 7 sort of eligible assessees who are required to file on the basis of their income continues. And now almost all returns, schema returns physical format have been issued. The electronic schemas are yet to get introduced. After those electronic schemas getting into through, then only practically we can start filing the returns. So there should not be any hurry to file the returns. Why? Because we know all those tedious TCS transactions, this time limit to file their 4th quarter returns expires only on 30th of this month, 31st of this month, after which 1 week may be required for the web portal sites to update all those figures in TDS, TCS, etc. Then only the employees would be getting their Form 16s. Then only that interest receiving persons would be receiving 16As and all from their respective deductors. So time is there. We have to wait at least till June 15th to start filing the personal income tax return. Even in case of any urgency, definitely yes, you may still file the return, and after all these things getting reflected, you would be required to revise the same. Apart from this thing, there can be certain transactions in AAS also. All those things also you would be required to get updated. So the first and fundamental thing for the time being that we have to keep it in mind is, now it's quite early period to file the returns, even though that schema has been introduced. Practically we cannot file the returns also right now. So let us wait for all those things to get settled. So what are all the various returns? ITR 1. In this year there is slight amendment for eligibility to participate this ITR 1. Earlier only those persons who are having income from salary, income from one house property, income from other sources and agricultural income up to 5,000 can opt for ITR 1. No person who are having capital gain or PGBP can enter into ITR 1. PGBP again, now also you cannot participate in ITR 1, but an exemption with regarding to capital gain, only with regarding to long-term capital gain. If you are having long-term capital gain up to 1.25 lakh, because after this amendment in 2024 bill, this amount of exemption of long-term capital gain under section 112A on listed securities, instead of 1 lakh rupees, it got up to 1.25 lakh rupees. In that context, if you are having any long-term capital gain which is taxable under section 112A, then you can now go for ITR 1. Apart from this, no major changes. All those minor changes we will be discussing later. And those persons who are for whom ITR 1 is not applicable, that is, they are maybe having some agricultural income more than 5,000 rupees, maybe having some income in any other sort of capital gain, maybe having income from more than a single house property, then they may be having some foreign income or foreign assets. Then in those category, if you are having income from all the other heads other than business income, then you can go for ITR 2. If you are having business income, then ITR 2 is also not possible, either ITR 3 or ITR 4. We know for business persons who are going to opt for presumptive taxation for those 44 AD, 44 ADA, 44 EE categories, then they can opt for ITR number 4. And if you are not opting for those presumptive schemes, rather you are going to maintain your books of accounts separately, and if you are going to upload that P&L account along with balance sheet, then as normal way you can file the return under ITR 3. For ITR 3, almost all other persons for whom business income is there, capital income is there, salary income is there, any sort of no restrictions for this ITR 3 form. So these are all those forms which are applicable for this individuals. Then comes HUF, BOA, AOP, etc. Individuals and HUF. Now comes those ITRs applicable for other than individual and HUF. For partnership sort, for AOP sort, BOI sort, for artificial juridical person sort, for all those persons other than company and trust who is having registration under 12AB, this form ITR 5 would be applicable. If you are a company, ITR 6 would be applicable. If you are a charitable trust, Section 8 company, society, exemptions under 11, 12, 1023C, etc., you are going to claim, and you are a registered entity, then you can go for this ITR 7. If you are a charitable trust but not registered under 12AB, then you are just treated par with AOP, BOI, ITR 5 would be applicable for you. These are all the categories and applicable eligible assessees with regarding each and every form in separate. Then with regarding to ITR 5, ITR 5 is not a form to file the return, rather the acknowledgement we all know. These are all various types of forms which is existing for this assessment year 25-26 also. All these things already I have mentioned with regarding to this eligibility for all these ITRs. Now, before filing the returns, what are all the things that we have to keep in mind? Some of those things are being plotted in this PowerPoint slide. Apart from which, preliminarily, we have to make it assured the type of an assessee. Suppose we are filing the return, or if you are a tax consultant, if you are a practitioner, then the client comes in. You have to see the residential status. If they are continuously here in India, no requirement to do all these things. But if they are frequent flyers, if they are having employed abroad, or if they are having some business abroad, or if they are traveling, foreign travel, they are having infrequent, then you would be required to check their passports. From their passports only, you would be getting to know how many days they have stayed in India. Then you have to do all those section 6(1) test for finding whether they are a resident or not. Then for ordinarily as well as not ordinarily resident. The key thing that you have to see at that time is to find whether those persons are deemed residents. Deemed residents as per 6(1)(a), you would be required to think over. Why? Because couple of years before only, even though you are not staying for a single day in India, still you would be treated par with not ordinarily resident, by virtue that you are an Indian and your total Indian income is more than 15 lakhs, and that income is not taxed anywhere outside India. Suppose you are in UAE. In UAE, the income tax from outside sources are not taxed there. So if you are staying there in UAE continuously, entire year you are there, but you are having some passive income, say bank interest, say some rent out of properties here in India, which is over and above 15 lakh rupees, then even though for a single day you are not there in India, still you would be qualified to be an auto-renewal resident by virtue of this section 6(1)(a). So all those things you have to keep in mind while determining the residential status. Why? Because if you are a resident, non-resident, all the forms, all the procedures, all the things that you have to file gets varied. Then after finding out their residential status, now you have to inquire what are all the types of incomes that they are having. Supposing there to be a salaried person, you have to get their salary slips. You have to get their Form 16s. You have to inquire whether any capital asset transactions were being indulged in during the period. Many of those transactions, capital asset may be share sort of transactions, may be high value movable property transactions. All these things would be appearing in AIS. But all those transactions need not be appearing in AIS. So you have to ask what are all the transactions which were being happened there. Or rather, even for a salaried employee, we have to get the bank statement from them. You have to go through the bank statement thoroughly. Any extraordinary transactions happening in and out, you have to ask what are all the things which has happened during those, or which were the transactions, what were for what those transactions were being happened, or the transactional amount sources, etc. You would be required to inquire about. Then you have to decide on the basis of the total income, on the basis of various deductions, exemptions, etc. You have to decide whether they have to go for new regime, which is default right now, or opt-out regime. For that purpose, even though an employee have declared for a opt-out scheme as per their Form 16, they have anticipatory salary while submitting. Suppose they have opted out for old regime. But if you find better than old regime, it would be better to go for new regime. You can still file the returns, even though that anticipatory or Form 16 is as per old regime, you can file the return as per new regime, or vice versa. For those purposes, you have to get the salary slip. You have to evaluate which are all those allowances. We know those allowances for which both new as well as old exemptions are available, deductions are available. But so many deductions and exemptions are not eligible for those persons who are going to opt for new regime taxation. So on the basis of all those information, you have to, year by year, you have to calculate, you have to compare, you have to analyze which type of income tax regime suitable for them. Then you have to advise them accordingly. After which, bogus sorts of claims, bogus sorts of exemptions, definitely yes. Ethical basis as well as on futuristic basis, you should not promote with. Income tax department is due diligent, very technologically advanced they are. They are having so many outside informations. So all those bogus deductions, all those exemptions without proper documents claim are subject to get scrutinized later. At that time, higher penalty. The tax has to be paid along with interest, 200% on misreporting income, which would be getting penalized. Apart from which, it can be taken back 4 years also for income escapement assessment. So all those things are there under misreporting, under those bogus refund claims and all. So all those unethical practices we should not promote with. Then, with regarding to those things, tax paid details. With regarding to those deductions, I was mentioning whether this new scheme is beneficial for them, old scheme is beneficial for them, for which you have to get all those salary slips, all those deduction related, LIC related, medical insurance, home loan related, all those deductions, everything you have to get all those things. Then if you are a businessman, not an individual salaried person, if you are a businessman or a professional, if you want to opt out from this default regime, then you would be required to file then EEA. And those restrictions and all, we know, switching over those regimes and all. For a non-business, non-professional person, you can switch on within 1 year to another year, you can swap from new to old, old to new, etc. But there is restriction for business person, professionals. Once you have opted out, then you can opted out and came back into this new regime, then you cannot again opted out back. So all those restrictions are there. So these are all those things with regarding to that pre-filing checklist is concerned. Due dates already I was mentioning. Now certain practical situations for business for which this 44AD, 44ADA as well as 44AB is applicable. First illustration, Mr. A started manufacturing first year, turnover all cash. The total turnover is 1.5 crores. Net profit is going to declare is 8 lakh rupees. Total income 8.5 lakh. So you know, if you are declaring less than 8%, 44AD would not be applicable. And over and above, the turnover is more than 1 crore rupees. So if 44AD up to 2 lakh rupees, up to 3 lakh, 2 crore rupees, up to 3 crore rupees, we can go for 44AD. 95% condition is satisfied, up to 3 crore rupees you can go. In all other cases, 2 crore rupees up to you can go for 44AD. In that case, tax audit maintenance of books are not required. But you are declaring less than 8%. So definitely yes, 44AD is not applicable. 44AB would be applicable. Then in next case, Mr. B, a trading turnover all cash 90 lakh rupees, net profit 10 lakh rupees, doctor fee 45 lakh rupees. We may be knowing if you are a specified professional, then you cannot go for 44AD. But for 44ADA, there are no restrictions if your turnover is less than 50 lakh rupees. And whether tax audit is required is the question. Tax audit is not required for the reason business turnover is less than 1 crore. Professional receipts are less than 50 lakh rupees. So 44AD not applicable due to the reason that she is a medical professional. 44ADA very well applicable. 44AB tax audit is also not applicable. Then Mrs. C, first year of business, turnover 80 lakh rupees, 4 lakh rupees net profit. So he is declaring less than 8%. But by the virtue of section 44AD4 and 44ABE, tax audit would be applicable only if you have opted in for 44AD and you have not sticked on with that option for the next 5 years. So in this context, definitely yes, Mr. C would not be required to file under 44AD. 44AB also would not be applicable. He can file the income tax returns in ITR 3 by uploading P&L account as well as balance sheet. Then commission income, person cannot opt for 44AD. So the reason his turnover is less than, is more than 1 crore. Because commission is a business receipt, 6 lakh plus 95 lakh, 1 crore, 1 lakh it would be. So he would be required to keep their books of accounts and to audit their books of accounts. These are all those permutations and combinations, whether you belong to 31st July category or 31st October category. So all these things you have to keep it in mind while selecting the due dates also. Then comes to recent changes in ITR forms for assessment year 25-26. First one I was mentioning, for ITR 1 as well as ITR 4, the capital gains you cannot mention with. But now after this capital gain under 112A becoming exempted up to 1.25 lakh, now we can go on to file this ITR 1 as well as ITR 4 having long-term capital gain up to 1.25 lakhs. Then the second cosmetic change is mandatory disclosure of TDS sections. In ITR forms now require tax to specify the exact section under which the TDS was made. So which is 192, you have to mention that 192, which is 193A, you have to mention all those sections which are from which the TDS has been deducted. Earlier, those persons who are required to give Aadhaar number was mandatory to get uploaded. Apart from Aadhaar, if you have applied for Aadhaar, that enrollment number, 15-digit enrollment number was also accepted. But from this year, no, not that Aadhaar enrollment ID is not accepted, application number is not accepted. Rather, the original Aadhaar number is required to file the return, otherwise you cannot file the same. Then enhanced disclosure for tax regime. Taxpayers opting out of new tax regime are now required to provide detailed information included the date and acknowledgement, etc. of 10IEA, ensuring the transparency in tax regime. That form details you would be required to give. Then clause level deduction reporting. Why? Because all those bogus deductions, bogus exemptions were being claimed by taxpayers I was mentioning. So those deductions under 80C to 80U must now be selected from detailed drop list, improving the transparency and precision in claims. Earlier for minor these things, others were being used, but now separate columns are being provided for all those deductions in separate. Then simplified relief for foreign retirement accounts. The taxpayers claiming relief under Section 89A for those double taxation reliefs and all for income from foreign retirement assets will be benefited from streamlined reporting process. Then at the time of filing the returns, there is a column to give the details of bank accounts. Even though in most of the cases, most of the assessees, even the tax practitioners would not be insisting the clients to give all the bank accounts that they are having other than dormant accounts. Now for the time being, only a single bank account is required. Then you can file the return. Why? Because a single bank account for the purpose of refund is required, otherwise you cannot file the return. For that purpose, only a single or one among the many accounts would have been reported by the taxpayer, but that is not the case from this assessment year 25-26. All the active bank accounts would be required to be disclosed in their respective returns. All those non-dormant, meaning active bank account. So what is active and all? In every bank account, interest would be debited, credited. Then it is not a dormant account. So for only being dormant for those long pending non-transaction, you need not disclose the same. Otherwise, all those bank accounts you would be required to do it. Even though it's a simple sort of thing to be done, but a small mistake or a small ignorance may lead to huge fines and penalties. Why? Because if you have not disclosed any bank account numbers, even though you are a personal bank account numbers you are having or business accounts, any of those debits and credits can be tantamounted to unexplained cash credits as well as unexplained cash deposits, unexplained transactions, etc. It can be deemed to be income, and income under 115 BBE can be initiated along with 270A 200% penalty. So all those consequences, if you want to avoid all the bank accounts, active bank accounts, you have to insist the assessees to produce and assessee to declare in their respective income tax. Yes. Expanded eligibility, ITR 1 and 4 already we have mentioned for capital gain earners. Then for unlisted bonds and debentures, why? Because before July 33rd, the rates are different. That time limits for making them to long-term, short-term is also different. From 23rd July, now 3 slabs are there, 36 months, 24 months, 12 months were there. Now everything should be within 24 months. In order to have that facility, 2 partitions have been given to report capital gains on unlisted bonds as well as debentures. Then if you are claiming dependent disability allowance, if you are claiming disability for yourself, severe disability, etc., then you would be required to submit that 10IEA form, within which you would be required to upload the certificate from the recognized medical authorities. All those things without which you cannot file that form IA. After filing that form IA only you can file or you can avail the deductions under 80DD, dependent disability up to 1.25 lakhs as well as 80U, self disability up to 1.25 lakhs. All those stringent conditions are being inserted for the basic reason that many bogus claims, that many bogus deductions are being claimed by the assessees. Then some common changes in ITRs. Separate reporting of capital gain I was mentioning. Capital loss on share buyback, if any, you can disclose it. Then threshold limit for asset and liability disclosure. Now the income has income which has been there for 50 lakhs right now have been increased to 1 crore. So only those persons who are having income more than 1 crore would be required to give the list of assets and liabilities of them. Then I was mentioning the detailed deduction report. Earlier others were there, so it is not possible. Separately, you would be required to give those deductions as well as exemptions. Then I was mentioning that TDS have to be separately reported, for which a new column has been inserted. Then for this 4BC, 44BC, cruise ship business, extra sort of 20% of gross receipts from passenger is a deemed section. Additional requirements in order to give various other data has been included for presumptive section under 44BC, which is not a normal sort of an situation. Then for 24B, we know the deductions for availment of home loan. So various extra columns has been inserted in the return in order to make it feel genuine, whether any bogus claims are being made. So in order to facilitate the same, enhanced disclosure have been required to declare under this section 24B. Now, not with regarding to the forms, rather certain subtle changes, amendments, which occurred in Finance Act 2024. All these things having those changes in tax rates, changes in income tax returns. Those amendments with regarding to Finance Act 2024 we would be discussing. Certain part of Bill 2025 as well as bill also, new income tax bill also, when and where required, we would be touching upon. So this 87A rebate is a hot topic, not only for the upcoming years, but also for the recently ended year, assessment year 24-25. So what is that much relevance on this 87A? We know lot of assessees who have claimed 87A. For those persons who have opted for this new regime, up to 7 lakh rupees, you would be eligible to get that 25,000 rupees rebate. For that sake, 7 lakh rupees up to, you would be exempted from paying any tax. And for specially rated taxes, if it comes to 143(1) orders, they have negated that rebate facility for specially rated taxable incomes in form of 111A, short-term capital gain, 15%, 112, 20%, 112A, 10% over and above 1 lakh rupees. And among those specially rated taxable income, only a single section, that is 112A, long-term securities after paying STT at the time of purchase as well as at the time of sale. There is a condition in section 112A itself that if you are having any income taxable under section 112A, then you would not be eligible to get 87A rebate. So that section 112A specific mention with regarding to ineligibility of 87A is there. But apart from that section, may it be 112, may it be 111A, or may it be 115 BB, lottery winnings, etc. In no other specifically taxable section, there is special mention this 87A would be ineligible. It is not there in 87A section also. So the department is supposed to give all these deductions, but in those 143(1), unfortunately, for all those specially rated taxable income categories, everyone, their refund is being reduced or they are getting demand notices. What is the remedy? The remedy is we are trying to go for appellate route, and almost all appeals are getting in favor of assessee only. But what happened to this assessment year 25-26? For the assessment year 25-26 also there is no change in any of those sections. In budget also there is no mention. But slowly in this February 1st, 2025 in the budget finance bill 2025, it is not in finance bill, rather in budget memorandum, there is a special mention. Why? Because this year the rebate of 25,000 got enhanced to 60,000 rupees. By virtue of that, 12 lakh rupees would be exempted from tax. In that budget memorandum, there is a specific mention that specially rated incomes, this rebate would not be applicable. Even though it is mentioned in budget memorandum cannot override the bill nor the act. For that reason, I do strongly believe for assessment year 24-25, 25-26, 26-27, for all those years up to that prescribed limits, 25,000 or 60,000, whatever it is, all those specifically taxable income other than 112A, you can get what? That rebate benefit, relief benefit. So within which, in the income tax bill 2025 also, no major changes. It continues to be there in income tax bill 2025 also. But one interesting point in assessment year 25-26 with regarding to 87A is, that is the year that we are going to file right now, with regarding to previous year 24-25, assessment year 25-26 is, even though you are eligible to get 25,000 as rebate, technically you would be getting maximum of 20,000 only. Again, to repeat, even though you are having 25,000 rupees eligible to be claimed as rebate due to an unintentional maybe mistake by the drafting persons, you would be eligible to get 20,000 only. What is the reason? Up to assessment year 24-25, if you see 0 to 3, it was nil. 3 to 6, it was 5%. 6 to 9, it was 10%. So that up to 7 lakh rupees, the total tax would have been 25,000. So those persons who are earning up to 7 lakh rupees, the total amount of tax, if they are not having any specially rated taxable income, I suppose, then up to 7 lakh rupees, the total tax would be equal to 25,000 rupees, and 25,000 rupees maximum rebate, you would be tax free. But this assessment year 25-26, there is a small change in individual tax slab limit under new regime. 0 to 3, 3 to 6 has been extended to 3 to 7. By that virtue, up to 7 lakh rupees, you would be having tax only up to 25,000 rupees. And if only the slab has been increased up to 7.5 lakh rupees, then only the total tax would have been 25,000 rupees. But unfortunately, the actual amount of tax, which is 25,000 or income up to 7 lakh rupees, you are eligible to get 87A. Up to 7 lakh rupees, now due to that virtue of increasing the slab limit, 20,000 only would be the tax liability. So even though you are eligible to get 25,000 rupees, due to this mistake in drafting the Finance Act, the total amount of rebate would be limited to 20,000 rupees. Hope you are getting the point. So that illustration I have given. 4 lakh rupees, this many incomes they are having. So those things that I was mentioning, that apart from 111A, 112A, all other income you are eligible to get a rebate, but the department is not allowing all those things. For assessment year 24-25, we were discussing the form. And for 25-26 and 26-27, I was mentioning, you would be having that rebate eligibility, as well as you would be having that option for marginal relief also. For this year, up to 7 lakh rupees, you are exempted from tax. If you are having income of 7 lakh 5,000, whether the entire income is taxable now, 5,000 rupees or actual incremental tax, whichever is lower, would be taxable. So here in this case, 5,000 only would be the tax. Not the tax on 5,000 rupees, but 5,000 would be the tax due to that marginal relief concept, which is there for the last 3-4 years. So all those things which I was mentioning has been illustrated there. That's it. Now come the second amendment. First amendment, 87A I was mentioning, and the intricacies regarding the 87A for 24-25, this year 25-26, next year 26-27, and after income tax bill included 27-28 also I was mentioning. Now comes this second quite important amendment with regarding to this capital gain. So in Finance Act 2024, major changes, radical changes I would call, in capital gain sort of taxation came in 2024 second budget, 23rd July 2024. So it made the total capital gain to be taxable as 2 halves before 23rd July, after 24th July. What were the 3 changes which was being proposed in that budget? Point number 1, I am reading from right hand side or left hand side on your screen. Change in holding period. I was mentioning there were 3 types of holding period. 12 months for listed equity shares, equity oriented fund, units of ULIP, etc. Then it would be for a 12 months period. If it is other than this land and building, all those bonds, etc., it would have been 24 months. For any other assets, it should have been 36 months. But now, for those gold, unlisted bonds, etc., the limit was 36 months. Then only it would become long-term capital asset, and the gain would become long-term capital gain, etc. But now, after this amendment, that 36-month condition itself is not there. That 36 months has been cut and short to 24 months. So now only 2 types of holding period, either 12 months, which is existing, would continue. For all other assets, the holding period would be 24 months. First and foremost change. And this is applicable from 23rd July 2024. Second one, short-term capital gain under 111A, which was taxable right at 15%. It has inflated, it has increased to 20% tax slab. Then long-term capital gain. 2 types of taxes were there. 10% for 112A, 20% for 112. For those listed securities with STT at the time of purchase as well as sale under section 112A, there was an exemption limit of 1 lakh. Over and above 1 lakh, then only it would be taxed at 10%. That exemption limit 1 lakh has been extended to 1.25 lakhs, a positive move. But the rate of tax from 10% has been increased to 12.5%. Then for taxable incomes under section 112, the normal tax rate till then was 20% with indexation. Now the tax rate has been reduced from 20% to 12.5%, but the indexation benefit would not be available. The cost of acquisition and cost of improvement as such, you had deduct from the total sale consideration, and the residue you would be required to pay the tax at 12.5%, no indexation benefit. So whether it is for all assets, the indexation benefit is negated. No, not the case. Wherein if you are an individual and a chief, that to a resident, for immovable property in form of land and building, if purchased before 23rd of July, sold after 23rd of July, then there is an option given for those assets with indexation 20% rate, without indexation 12.5% rate. So that option has been given to those specified individuals and HUF. Again, do I repeat those conditions? This option for indexation only available for resident. Again, do I repeat? Resident individual HUF, and only in case of land, building, etc. immovable properties. That too purchased before 23rd July. If they are purchasing this after 23rd July, 5 years, 6 years after this they are selling, then again for them this benefit would not be eligible. For non-resident individual HUF, it is not eligible. For gold, any other movable properties, this benefit would not be eligible. Only for those restricted class of persons, specified persons I would call, for them alone, this exemption or that option that you can either with indexation at 20% or without indexation at 12% you can go about it. These are all those critical changes as far as those capital gains are concerned, and all those implications for the first time for the financial year 24-25, assessment year 25-26. Now we have to deal while filing this year's income tax returns on or before those due dates. Various illustrations I have mentioned. Regarding this capital gain adjustment, I was mentioning Mr. AB purchased land and building on 1/4/2004 for 5 lakh and he sold the same on 24/7/2024, which is one day after 23rd of July for 20 lakh rupees. Compute the capital gain if he is a resident individual. So for this thing, it's an immovable property. He is a resident individual and the property is purchased before 23rd of July. It is sold after 24th of July. So here he is having that option, either with indexation at 20% tax or without indexation at 12.5% tax. He can opt in with in first instance. So if you go by the tax with indexation is 78,761. Without indexation, the tax is 1,87,500. So he can opt in for with indexation at 20%. But it would change case to case, situation to situation. Gap between the consideration of purchase with that of cost. All those things relatively that option which would be beneficial would vary. Then if he is a non-resident individual, no option is there. You have to go for without indexation 12.5%. So instead of the assessee being a resident individual, if the assessee is a resident individual, but instead of asset in form of land and building, suppose he is disposing gold, whether the benefit would be eligible, answer is no. I was mentioning this option is only applicable if you are selling immovable property. No movable property, this extension list is being included. So if you are selling gold, again, you have no option, rather to go for without indexation 12.5%. Then if you are a partnership firm, then again it is not possible. It is only applicable for individual resident. So all those things are being plotted here. So with this simple illustration, I was just trying to give various permutations and combinations with regarding to the taxability of capital gain with respect to this year as well as for the following years. Then various other points to be discussed. Suppose an person, walk-in client comes in, supposing the client to be an insurance agent. They haven't filed a returns for last so many years. In every year, you can see 5,000, 10,000, 20,000 tax credit. Now he approaches you. He asks you whether you can claim those refunds back. The answer is prima facie no. Why? Because updated return within limit, you cannot have refund. You cannot submit 139.1 or 139.4 right now for the previous years rather than the current year. But this rule 37BA gives an out. But because for those persons who are having income under PGBP as well as income from other sources, under section 145, you are having an option either to go for cash basis system of accounting or mercantile system of accounting. So if we are going for cash system of accounting, presuming you have received all those income right now, then all those credits you can carry forward in that TDS column. You may be seeing in that TDS specific column, there are options. Previous year's tax which not have credit has not been taken, carry forward up to 8 back years. You can take the credit and you can avail those input tax credits in form of refund also. So you may utilize this rule in order to get those previous TDS credit unclaimed as a refund. Then if you are not filing the return within time limit, 234F penalty would be there earlier. Penalty under 271F was there. Now 234F only would be applicable. If your income is less than 5 lakh rupees, total income, 10,000 rupees would be the late fee. If it is over and above 5 lakh rupees, 5,000 rupees you would be required to pay. What are all the consequences for this thing? Then 234F was there. 234 ABC interest you would be required to make. And if you are, if you see for this 206 AB and 206 CCA, it is no longer applicable. 206 AB and 206 CCA was applicable if you have not filed the return and the 139 time limit is over, and your total TDS and TCS credit is more than 50,000 rupees. Then if you have not filed the return, your deductor would be deducting at double the rate or 5%, whichever is higher. Same, collecting your 5%, 5% your actual rates double, whichever is higher. But this Finance Bill 2025, Finance Act 2025 have removed those conditions. So those consequences of non-filing, that thing would not be applicable from the current assessment year. Other forms, ITR 1 to 7 are the normal forms. Along with those forms, definitely yes, some of those sub-forms also would be required to get filed. Say if you are a tax audit assessee, you would be required to upload 3CA, 3CB. Then only you would be allowed to upload the respective ITRs. Otherwise, it would turn down to be as an defective return. Then if you are claiming any relief under section 89 in case of salaried persons, arrears of salary, etc., then in order to get that 89 relief, you would be required to file this form 10E, without which form would be getting or the defective, or you would be getting demand notices. So likewise, there are various forms which are also required to get filed. I was mentioning if you are having that 80DD, if you are having that 80U deductions, you are required to file that 80IA, etc. I was mentioning. 10IA I was mentioning. So likewise, if some forms are required to be filed, those mandatory forms you would be required to file. Otherwise, your return is subject to get defective, would become null and void consequently. So about those basic, some of those forms which are required to file along with or before filing the income tax returns I was mentioning. First among the same, 10E itself. For that 89 relief, if you have received any ideas, gratuity, etc., employees are eligible to get relief on cash or accrual basis, whichever is beneficial for them basis. On that account, if you want to claim those relief, you can file this form 10E, and you have to clearly give the incomes of those previous years, arrear details, everything online you can file. So if that 10E figure of relief is equivalent to the relief that you have claimed here and all the computations are correct, all the particulars are true, then you would be eligible to get that relief under section 89. Then if you are an author, copyright, patent, etc., 3 lakh rupees you can get under these sections 80WQB as well as 80RRB, subject to various other conditions. So for getting that an exemption, you would be required to file an extra form in form of form 10H. If you are claiming all those deductions, exemptions, when these forms are required, in ITR form itself, say 10E, the date of filing of 10E you have to give, 10H, date of filing of 10H you have to give. Otherwise, there would not be any correlation between the return filed by you, even though you have filed those things, you would not get it. And suppose you have uploaded the return without uploading this form, what would happen? I was mentioning the demand would be created, the deductions would be disallowed or defective return would be there. Then you have to file these returns and you have to revise what? The original return that you have already filed. That is the way out. Then form 10BA, if you are having any ATGG, rent deduction, if you are not having any HRA, if you are residing in an rented house, subject to other conditions, ATGG, up to 25,000 per month, you can, 25,000 rupees you can have the deduction under this ATGG. So in that case, definitely yes, you have to file this form 10BA. All these forms are being made mandatory just to plug those bogus sorts of deductions which are being claimed by assessors. Then and where again, some of those dubious mafia groups are trying to do all those malpractices. So these are all various forms that you would be required to file. So in this session, actually, we were having a discussion over those basic statute 139 provisions in order to make the return filed, belated return, its consequences, revised return, defective return I was touching upon. Various forms ranging from ITR 1 to ITR 4 also I was mentioning. The precautions to be taken, the procedure I was in brief mentioning. The recent amendments which came in the respective forms also I was running through. Then regarding those recent amendments, especially in rebate, capital gain, etc., I was going through some illustrations also I was mentioning for better clarity. So all these things already I have taken through. Now the last 20 minutes belongs to question and answer session. So madam, any of those questions in question and answer box you can pick, or otherwise I can go through and would be answering as per those questions. Any questions from participants part regarding the return submission? Definitely yes. You can still continue to textbook. Madam, are you there? Okay, I shall start picking the questions. Subha madam, request slide on ITR time limit for belated return, updated and defective return. Madam, separate slides are not there. I will be again mentioning you the time limits. Belated time limit for the normal period is 31st of July for non-tax audit cases. For tax audit cases, 31st of October, and for international transaction 92E cases, it is 30th of November. After that due date, up to 31st of December, you can file belated return. Updated return I was mentioning, 48 months back from the end of relevant assessment year, you can go and file updated return subject to extra 25%, 50%, 60%, 75%, 70% tax under 140B. Then defective return, after getting the notice of defective return, within 15 days, you would be required to file the defective return back. Then from anonymous, one question. Sir, what is the scope for changing from old regime to new regime and also back to old regime with respect to ITR 1, ITR 3? For ITR 1, sir, there is no business income. So then and when you require, you can opt out, you can opt in. So for both 10 IEA is the form, you can swap year by year. But say for assessment year 25-26, you have went for old regime. To revise the same, you cannot go back to old regime or new regime. So within the year, if you are revising the returns or updating the returns, you are not getting that option to swap. But this year, you are going for next year. If you have opted for old regime this year, next year you can go for a new regime. For swapping, there is no restriction if you are not having any business income or professional income. ITR 1 meaning you are not having any business or professional income. But that not the case for ITR 3. If you are having business income, once you have opted out, then one time you can come back to this new one. Then back to old regime, you cannot go back in your lifetime till you are having business income. But now you are having business income after 5 years. You are not having any business income, then you can go back to old regime again. So these are the restrictions for business and professional income persons. Hope you are clear. Then what is the time period to be considered as account as dormant? The bank would decide, sir, long time you have not conducted any transactions and your balance is lower than that of the prescribed limits, then the bank would be considering them to be as dormant. In Income Tax Act, there is no limit. Banking policy would make them to be dormant assets. TD Babuji, sir. The next question, person having salary income and long-term capital gain are required to submit ITR 1 or ITR 4? So ITR 4 is for presumptive tax person, sir. If you are having salary income and 1.25 lakh limit, I was mentioning 112A, then you can again from this year ITR 1. But any other capital gain, then your form is ITR 2, not ITR 4. It's ITR 2. Then you need not worry about all those forms. If you are filing with any tax software, it would guide directly you to find which are all the forms which are applicable. Or at the time of filing the return directly in the income tax website, the website again would be guiding you to do it. Then Shubha madam have asked, is secondary band holder is a joint account mandatory? Yes, joint accounts also. Both the husband and wife, suppose they are having, husband also would be required to declare, wife also would be required to declare. Otherwise, if every account is a joint account, no account is required to get declared now. For joint accounts, every person would be required to do it, both primary as well as secondary. How we will get CEP credit for this webinar that you asked with the department, sir. Webinar PPT I would share with the TRD. They may be giving to you. I don't know. So any other queries? Another 15 minutes more. Any queries from your part? Definitely, yes, you may ask. ITR filed under old regime having professional income last year. Can the client opt for new regime this year? Yes, you can. For one time from old regime to what do you call? Old regime to new regime, you can come. Then back to old regime until you are having professional income, business income, you cannot opt out. Satyanarayan. At tier 4 also, there is the same case. Any other doubts? You may. So first and foremost thing, to sum up, now say up to 15th of June, you may wait for filing the income tax return. All those TDS, PCS returns, let them get submitted, let them get appeared in your 26 AS, all those AS transactions, etc. may get rolled in. Then you can ask the clients to give their return file. Some couple of questions again. Samir sir, I want to ask sir how to file revised return assessment year 21-22 as my employer changed the declared income on lower side. I didn't get your question, sir, but anyhow, I do presume that 21-22 assessment year, some income have been lowerly declared. Even though the employer have declared it lower, you are supposed to give the actual figures. But if it is different from the actual figures, if you have filed, now you are having that an option for a revision under section 264. You can give a revision petition to the commissioner. Commissioner have the power till 4 years to revise the return. So ASAP, you can go and do that exercise if required. I'm not allowed to update the return to be filed. Samir sir, yes. Why? Because the returns are not yet notified. After notifying, we can file the updated return as I was mentioning. Up to 4 years back, you can go back and file your returns. Updated returns. Then some more questions have arisen in question and answer box. One anonymous, whether rebate or under 80D 10IE will be available in old tax regime. The question is not clear. 80D deduction, I do believe, would be available in old tax regime. In new regime only, there are restrictions. For new person filing for first time, will any questions are supposed to be come for earlier years? It's actually a notion, sir. Somehow you have to start filing. If you fear, why not you have filed the return for previous year? For the lifetime, you are not going to file the return as such. So even though it is for first year, anything should have first enough. You file the return, don't worry about previous period. How many times you can file rectification under 154? There are no, statutorily speaking, there are no limit. But if only specifically required, then you are allowed to do the rectification mistake. Otherwise, some other scrutiny or income escapement assessment may ponder upon you. If required, you have to rectify the same. So make it assured further rectification would not be required after making the present rectification. So a single sentence answer, even though there are no restrictions, try to make it minimal. Sir, you discuss only major changes. Can you have a brief of any minor changes? No, that much minor changes which are having direct impact, madam. If direct impact, definitely we may have definitely discussed. Nothing to worry. Everything required for this assessment here, all changes I have discussed with you. Question from Shubha. What could be the percentage of split of income between spouse in ITR? Madam, it depends. Clubbing provision you have to see. On that basis, 56 to 60, you would be required to split the income between spouse. NB Vaidyanathan sir, TDS deducted by client but not deposited or deposited at a later rate. Still we can claim TDS or claim refund or adjust. I was mentioning sir, the previous credits, NB Vaidyanathan sir, previous credits on which you have not availed the credit in the TDS column, previous credit not availed. You can carry forward and claim it this year. If the total tax payable is lower than that limit, you can claim it as refund. Anonymous, whether standard deduction is available if IT for 25-26 is filed under old regime. Yes, sir, standard deduction of 50,000 rupees, no, is available for old regime also. Only thing is standard deduction for new regime is 75,000 rupees. Radhika madam, PIA, two things is thanks in advance. Good afternoon all. TDS deducted by client. Taxpayer is not required to get penalized, but you have to make it assured the tax your deductor have filed it on a proper way. Otherwise, legal remedies can be taken against the deductor. On anonymous, another question: what conditions should be fulfilled to get IT exemption on income from outside India in foreign exchange? There are no this thing, sir. If you are having tax paid at that country of origin of income, then you have to see that double taxation avoidance agreement. What would be that taxability on such income? On that basis, you have to tax it. In certain cases, it would be totally exempt from India. It would be taxed only there if the treaty so proposes. If not so, you are having that exemption or that relief under 89A, double taxation relief is there. You can compute and you can avail it. Mete client recently, he has not filed his return since 21-22, so it would be filed now. I was mentioning for those 22-23 itself, you can file updated return, provided you can pay that up to 70% extra over and above the normal rate of taxes along with 10% penalty. Then updated return you can file, wait for another 15-20 days. The system would get updated, the portal would get updated. You can file the updated returns. You can file for the last 4 years along with this year. Up to 5 years, you can file the returns. Indexing facility for land and building is only for land and building. Long-term capital gain or is it available for other immovable capital? Other than land and building, which are the immovable properties? Sir? For all immovable property, it is available, not for movable property. Whether long-term capital gain will be included in total taxable income for calculation, whether long-term capital gain will be included in total taxable income for calculation, definitely yes. But at a separate slab, suppose you are having 7 lakh rupees salary and 5 lakh rupees capital gain. 5 lakh rupees capital gain would be taxed at a specific rate. If it is long-term capital gain at 112, short-term capital gain of Social Security at 111A, and the 7 lakh rupees would be taxed at basic slab limits. Any further queries? You can question. You can put it in your question and answer box. So to sum up, I was mentioning wait till 15th of June to submit the return. Get all those documents from the client. Get confirmation from them also. Kindly do update the email ID and the mobile number of your clients. Kindly do check whether any notices have been issued, any outstanding demands are there in the web portal. Make it assured the client's email ID and mobile numbers are being updated in their respective income tax portal. Because otherwise we would be under this dilemma after issuing notices. If they have not found, you have not found, and your mail ID has been given, you would be under question. So to avoid that situation, definitely yes, you can make the mail ID and mobile number of the client appearing in that income tax web portal. Then AAS is only an indicator. Really don't follow the figures issued by AAS. There are various misinformation in the AAS. So actual data, sites and capital stock market transactions appearing in AAS. Kindly don't copy paste figures from AAS. You ask the client to get those required information from their participants, their stock brokers. On the basis of that profitability, you can file the returns. Don't follow AAS assets. Separate ID for each holder is generated even if joint account is there. Whether updated return can be filed for nil return? If not, what is the alternative? Nil return not possible, madam. You just give some income. You pay at least late fee. Then only system is accepting. Even though it is not there in the rules for updated return, but it is still that way only. If no questions, let us wind up today's session. Thank you, TRID department, giving me the opportunity to have a discussion on a very relevant hot topic on return submission. Thank you all. Almost 300 attendees were there. Thank you all for your participation. Thank you for your patient listening. Could meet you soon in some other session.
We thank you for your participation and your contribution, sir. Thank you for today's session. We are ending the session now.